Hello, and welcome to our 6 short courses to financial freedom. This is course number 4 on proper protection. Let's begin. First, let's define what we mean by protection. When we talk about protection, we mean protecting your income and assets in case anything were to happen to you. For instance, sudden death or disability is not only emotionally and physically burdensome, but it's also financially burdensome. Not only did we just add more medical bills, but potentially lose the ability to bring in future income. We can protect ourselves and family from the financial burden by transferring the risk to an insurance company. When you have a lot of financial responsibility, you may want to consider life insurance to minimize the financial burden and to make sure your family has the ability to continue on without being financially devastated. Many have lost homes and filed for bankruptcy due to medical bills and loss of income. Proper protection is the foundation to building financial freedom. Life insurance can be confusing when you don't know what you're looking for. To help you get started, we will cover some basic things you should know about life insurance. First, we will share with you some basic differences between a temporary and permanent life insurance. What are some advantages of cash value life insurance? And we'll help you find out how much you really need. Temporary versus permanent life insurance. A term life insurance is life insurance that provides coverage at a fixed rate of payments for a limited period of time. So when you hear the word term, you can think of temporary insurance. It functions in a manner similar to most other types of insurance in that it satisfies claims against what is insured if the premium are up to date and the contract has not expired. It does not provide for a return of premium dollars if no claims are filed, meaning if you don't use it, you lose it after the term ends. After that period expires, coverage at the previous rate of premiums is no longer guaranteed, and the client must either forego coverage or potentially obtain further coverage with different payments or conditions, usually higher. Since the older you get, the more costly life insurance will be. If life insured dies during the term, the death benefit will be paid to the beneficiary. Term insurance is typically the least expensive way to purchase a substantial death benefit. Term insurance is not generally used for estate planning needs or charitable giving strategies, but is used for pure income replacement needs for an individual. Permanent life insurance is life insurance that covers the remaining lifetime of the insured, which guarantees coverage at fixed premiums for the lifetime of the covered individual unless the policy is allowed to lapse. This includes whole life, universal life, and variable life. There are more options for riders and living benefits in permanent life insurance. You can think of riders as added on features and living benefits, meaning you don't have to die to access the money. For example, if you have a long term care rider, you can access the money if you qualify for long term care. You also have the option for flexible premium payments and cash value accumulation. Term and permanent can serve different purposes. Find out which one is right for you. How does the cash value inside a permanent life insurance work? When you make a payment to your premium, a portion of that goes into protecting you and your family, and another portion goes into an account that grows over the life of the policy. When planned appropriately, funds accumulated in the cash value can be used to fund purchases like a home, car, wedding, or education for you and your children. It can also be used to supplement your retirement income. Some advantages of a cash value life insurance is that you can generate tax-free income at zero market risk. It's protected from creditors and Uncle Sam, meaning you don't have to pay taxes on the gains, and you have more flexibility on when and how to spend the money, unlike other accounts that you might have with tighter restrictions. Now that we have covered some basics about life insurance, how do you know how much protection you will need? We have a simple formula called the DIME formula to help you calculate how much protection you will need for you and your family. DIME is the acronym for debt, income, mortgage, and education. Debt is the total debt that you owe, credit cards, car loans, or any other loans that you may have. Income is how much you earn, and you can multiply that by the number of years you want your family to have your income coverage. Some people just want 3 years because they believe that's how long it will take for their family to get back on their feet. Some want more, some want less. That is up to you to decide. Mortgage is a pretty big bill. So if you have a home and you're still paying the mortgage and you can put down the amount left on your mortgage loan. And lastly, if you have any kids and you plan to help them through college or any other educational institute, you can calculate that in as well. You might ask, I don't know how much tuition will cost. You can use the average per kid for a 4-year college degree and multiply that with the number of kids you have. Having proper protection is the financial foundation of financial freedom. Jack Ma said it best. Buying insurance can't change your life. Instead, it prevents your lifestyle from being changed. After toiling for decades, an illness can wipe out an entire family's saving by medical bills incurred. In times of tragedy, when faced with possible loss of life, one is once again reminded of the purpose of the existence of life insurance salespeople. That concludes our course on proper protection. If you need help with finding proper protection or want more information, download our worksheet and set a time to chat with one of our financial professionals for a complimentary evaluation. Thank you so much for watching. If you liked it, please share it to make the world a better place.